All right, stocks on the move higher. The S&P 500 reaching above 6,500 for the first time ever. Our next guest noting that while August and September have tended to be weaker and more volatile months in the calendar, anybody still waiting for another major correction this year likely to be disappointed. Here to discuss this and more is Thomas Hayes. He's Great Hill Capital's chairman and managing member. So Tom, let's just start. Let's start away from maybe the overall look at markets and something you flagged in your note that we've talked about this summer, but I want to kind of double click on, which is the most shorted stocks, like the meme trade, things everyone hates. If you pull up screeners, you can do it 3 different ways, but some of those most shorted names, I mean, it's intuitive, short squeezes happen all the time, but like we have seen some of those names be real market leader stocks have doubled, tripled. Yeah. What does that say to you about sentiment in this market, and how has that really evolved, just over the last couple of months?
Yeah, this is the keep your job trade, because basically you had $1 trillion of equity sold in the whole April 7th. Yep. Managers simply haven't caught up. They've been skeptical the entire rally, most hated V-shaped rally, and what we get trapped into as investors is recency bias. We think what's happened in the recent past is going to happen again. On average, the last 100 years, we've had 20% corrections every 3.5 years. We've had 3 of those in the last 5 years, so everyone's like, when's the next one coming? The next one is not coming, not coming soon. 3 to 5% dips from now through the year end. You want to be a buyer. Managers are going to be buyers, but they can't chase what's already up. They can't chase Mag 7 and catch their benchmarks. What they have to do is chase the laggards, and you know what? Chair Powell's about face kind of on Friday has paved the way that this trade can really, really work into year end because it's concentrated in small caps and mid caps.
Can I ask a theory that I have around the Liberation Day, like the problem it caused? The timing of it has not been discussed that much, that it was literally the second day of the second quarter. And like there's a quarter balancing portfolio flows piece of it around a lot of people got a lot of money in the door, unexpected event happens, you're like, I don't want anything to do with this. And to your point about catching up to the benchmark, I think for a lot of portfolio managers, you were kind of double hit with the uncertainty of tariffs, what the impact is going to be, and also issuing these client statements, you're getting flows. You don't people send you a check on April 1st, like, here you go. You're like, here I go. Like, what are we doing now? And I think that, in terms of the benchmarking, the stuff that isn't really a day-to-day part of the conversation, like that behavior shows that people are sending out statements they don't want to, on June 30 and then again on September 30.
Yeah, I think there's something to that. I think where you really get screwed, honestly, as a manager is if you're chasing indices and day-to-day ticks. I mean, what we did a conference call with our clients on literally on April 7th. And we went through every single portfolio company by company, and assumed the worst case scenario with tariffs. They were pricing in beyond the worst case scenario. And I said, listen, I have never asked anyone to send in money, period. And there was one other time I did, which was the fall of 2022, and I said, if you're going to send in money, now's the time. And at that time, we were buying tech, which was, you couldn't give away Google, you couldn't give away Amazon.
That is now 70%.
We did the exact same thing, and my clients stepped up, and we bought everything, because if the worst is priced in and you know what you own on a company-by-company basis and solvency risk is off the table, so maybe you get a couple quarters of margin compression, you've got to be a buyer there. There's no way to outperform if you don't take advantage of dislocations. Otherwise, you have efficient market theory.
Right.
And then there's no room for an active manager. So when it's raining, you got to roll. You got to just put out the umbrella and go buy.
All right, there you go. All right, let's talk about a name you do like, Intel.
Yes.
So I'm just curious what you make of this whole situation, because there's 2 tracks. You've got the fundamental, like, what's going on with the company. Can Lip-Bhutan turn this thing around? And now the government's, 9.9% passive equity holder.
Yeah. So
allegedly passive. Formally passive, let's say.
So we can have the ideological argument: should the government be a stakeholder? Should they not? Should the taxpayers be a stakeholder? Should they not? The fact of the matter is, they took our money. We should get something. Okay. So now existential risk is off the table, which means if I'm a potential client, we saw NVIDIA's earnings. NVIDIA's growth deceleration, massive growth deceleration in terms of sales growth, is not for lack of demand, it's for lack of supply. That 18A node in Arizona is going to get done. And on the back of the government's investment, you saw who? Masayoshi Son, SoftBank said, oh, government's in, I'm in. Here's $2 billion, let's go. I believe Intel can be an advanced chip designer. And then lastly, you're betting on the jockey. Lip-Bu Tan is a rock star. He came into Cadence Design Systems when the stock was down 86%. Over the next 14 years, if you had invested with him, you got a 68 bagger. $1 million became $68 million. I'm not saying that's going to happen with Intel, but if they get this fab right, here's the thing. AMD, NVIDIA, Vago, all of them, they are designers. ARM Holdings, they design, they don't produce. So they rely on the kindness of strangers. If Taiwan Semiconductor goes away tomorrow, they are out of business. They desperately need Intel to succeed. And once Intel succeeds, where are they going to direct their orders? If they want an ear in Washington, they're going to direct them to Intel. If they want to spread their risk, they're going to direct them to Intel. It's going to be a monopoly. Let's call it a duopoly. It's going to be a very good thing, and Lip-Bu Tan is going to be a hero.
All right, Tom, stick with me. All right, time now for some of today's trending tickers. Still here with me is Great Hill Capital's Thomas Hayes. We're taking a look at Tesla, Snowflake, and Amazon. So let's start with Tesla, the EV maker's troubles in Europe continuing to add up. Tesla EV registrations, a proxy for sales on the continent, down 40.2% in Europe compared to a year ago. You see the stock here down about 1%. And I guess as we think about this kind of name, Tom, it's just like for Tesla, there's the Elon piece of it, and now the Elon government part feels like it's moved on, and now we're just talking about like, are sales growing at any rate? Like, what's the fundamental story here for how many people are going to buy Teslas and all the places they sell them?
Yeah, I mean, down 40%. Other than that, how was the play, Mrs. Lincoln? I mean, holy cow. I will say he's doing some innovative things. He's got that Tesla YL coming out in China, which is a 3-row Tesla. That should help offset the competition. But competing with BYD, they're beasts. I mean, this was Charlie Munger and Buffett's kind of sole China play for a decade. It took a decade to work, and then it was like a 20-bagger in 2 years. And they can perform. They are very, very competitive on features. So I think Elon is now getting close to sleeping on the factory floor again, and he's going to innovate, and he's going to catch back up. He puts out a good product. I just bought one, brand new one for my wife. I'm not an EV guy. She wanted one. I was like, all right, I'm the last of the party. Maybe it's over. But it does some incredible things. And now you can talk to Grok. And if you look at some of Grok can get pretty nasty on different settings. So a lot of fun there. So look, I think the story with Musk is he will paint a picture of the future with the humanoid robots, with the full self-driving, to buy him enough time to fix what's broken. And historically, he's done that over and over and over, and sooner or later, he fixed what's broken. So if he broke the brand a little bit, if he fell asleep on innovation and refreshing the designs a little bit, he'll get there. The guy knows how to do it.
All right, let's take a look at shares of Snowflake. That stock up double-digit percentages at last check. I think up as much as 20% during today's trading session, up 21% right now. Company forecasting product revenue for fiscal 2026 that's higher than the street was looking for. This is a name that's up 60% this year. It's more than doubled over the last year. Now, Snowflake, probably one of the hottest IPOs that we saw in that COVID era, has not recaptured its highs hit back in 2020 and 2021. But Tom, when I see a move like this in Snowflake, I am reminded of, I want to say it was like 2 or 3 weeks ago. I feel like the meme everywhere was like, software's dead. You cannot touch software. You like get away from software. And of course, we have Snowflake up 21% after earnings. And they're not the only name in that space that we have seen make a big move in the last couple weeks.
Yeah, we saw MongoDB.
That's right.
I mean, welcome to Crazy Town. Only in today's market can you trade at 25 times sales, lose money like crazy, and be worth $80 billion. I mean, what else do you want to talk about? But look, it's part of the AI theme. They were left for dead. Now people are like, well, maybe they're not dead. And they performed better. They grew their customer base by about 10%. Their retention was 125%. So some positive things are happening there. So price is what you pay, value is what you get. A lot of great things happening. Is it worth $80 billion? I don't know, not with my money, but for someone, it makes a lot of sense.
Yeah, it certainly feels like maybe to where we started the conversation around certain portfolio managers, maybe looking for shots here and there. This is a name that has, after a long period of not acting well, started to act quite a bit better.
Sure.
All right, finally, let's take a look at shares of Amazon. That stock up about 1% on Thursday. Now, the move comes amid a broader tech rally, but we've also got some interesting product news, really for Amazon as a media company. And as all media companies continue to jockey their offerings, jockey attention ahead of football season, which I guess kind of starts tonight, Amazon and NBCU announcing a deal on Thursday for Amazon's Prime Video channels that will host an ad-free version of Peacock. Basically, you can now subscribe to Peacock through Amazon Prime. They join Paramount Plus, HBO Max, Apple TV as one of those options. And I'm just curious, Tom, from your perspective, both as a consumer and an investor, how you've looked at this really consolidating phase within media and consolidating around the tech players. I mean, YouTube now kind of is TV. Amazon now has all the major sports just about in their ecosystem. And it's, we're kind of back to this place where it's like, well, what did you think was going to happen? I mean, the biggest companies were probably going to be getting the biggest mind share,
It feels like it's a duopoly, but Netflix is the producer of content and Amazon is the reseller of content. It's almost like, to a lesser extent, Amazon is almost, to a lesser extent, given up on producing their own, and they'll just resell. And I find myself, I'm like, why do I have so many subscriptions inside of Prime? I used to have them outside of Prime, but I got tired of like clicking all over the Roku 80 different directions. I was like, I just buy them all. The HBO's in the Prime, the Peacock soon will be in the Prime, et cetera. So look, it's nice to see that Amazon continues to add value to Prime members and continues to get people into their ecosystem and continues to innovate, but it's a juggernaut, and this is just one more play. I think there are a lot of left-for-dead cable channels, per se, that are like small public companies that are going to get consolidated into the bigger players, and seeing NBC Universal spin out of Comcast and some of the channels there. So it'll be very interesting to see how this evolves. You see success now with Disney Plus, profitability, what they're doing with ESPN. So everyone said, well, it was all about numbers first, and I was like, oh my gosh, we have to make money. What about that? And now like Disney Plus is making money. Some of these other stations, I think, as they get consolidated and you get economies of scales on bigger platforms, they'll be able to make money. And there's a lot of tremendous valuable content out there. I love what Amazon's doing here, and I think it'll be good for the industry.
It's not very millennial of me, but I'll tell you what I have. I have cable. It's great.
Exactly. Only one.
I turn on the TV. Everything's there. Fantastic service. Someone should really look into that.
Yeah, I tell you, it could all the bundling that's happening. We're going to wind up right back where we started.
I am a happy customer. Yeah. All right, coming up, we're going to take an inside look at Hennessy Funds, and we are still joined by Tom Hayes with Great Hill Capital. David, let's start something that you flagged in your note to us, which quite interesting for the banking sector. I know it's been talked about over the last few months or so. The M&A outlook. Haven't seen a ton of action here for quite some time. Where are you looking to play that, or how are you playing it? And just what does that do for the overall sector, the overall industry, really, kind of getting unfrozen here after almost 2 decades?
Yeah, I think the last comment, unfrozen, after 2 decades, it's been a long 10, 15 years. The regulatory structure obviously tightened down after 2008, and they haven't been able to breathe for a long time. And the hope, I think, is that we will continue to see sort of a deregulatory push, and that will create, acquisition activities, not only in the traditional banks, but in the non-traditional banks. So I think it's, that's historically been a big value creator for investors like myself. Banking is typically a kind of a boring business. It's a get-rich-slowly process, but the acquisition process sort of accelerates that and gives you opportunities that you wouldn't otherwise have.
And Tom, for your for your portfolios, your work, thinking about how where the financials fit into that, are there any names that you like, any ways that you've positioned, or I guess maybe just sort of a macro view on the sector and how it feeds into some other trades?
Yeah, 2 things. I would say if I'm going to play banks tomorrow, I'd be playing regional banks. I'd be playing the small caps. I think there's more upside there. I think there's going to be a lot of refinancing happening. If you look at earnings growth of small caps, 35% next year, trading at 17 times versus large cap or S&P 500, 13% earnings growth next year, trading at 22 times. So that's helpful. Our biggest financial position, believe it or not, is PayPal. It's been left for dead. Alex Chris came from Intuit. He ran the small business division, had a huge multi-bagger there. He's doing some innovative things at PayPal. They're generating record free cash, buying record amounts of shares back, doing a lot of stuff with Venmo, with PayPal. Their transaction margin is expanding. So I like the innovation in the international aspect. They're one of the top stablecoin issuers. Most people don't know that about PayPal, so they're on the cutting edge, believe it or not. And 435 million users around the world, so it's very hard to destroy that when you're generating that kind of free cash flow. So we're playing it in a non-traditional way at the moment, but I do see the M&A story, I do see the banking story, but I play it on the smaller bank side to the point that he was making about the deals.
You know, David, it's interesting. PayPal is a name that you flagged to us in your note, and also just that broader, and Tom mentioned the stablecoin trade, that broader, whether you want to call it crypto, fintech, like let's say next generation banking. How are you thinking about that role and what names might fit into your portfolios, your funds as a result of these changes?
Well, I think there's a lot of names that fit there now. I think the issue has been that the traditional banks have lost share to private equity, private debt, to things like PayPal, to you name the you look at Hood, you look at Coinbase, you look at even something like a Rocket. These are all companies that are taking share, and this gets back to sort of the M&A side of it. The banks have to find a way to sort of recapture that momentum and get share back, and M&A is a way to do that. Entering the businesses are a way to do that. So I think the three things I look at is the value of M&A in this business, the value of new products and services that the deregulation will bring, and the benefit of hopefully some sort of use of AI to cut costs. I think if you go back 40 years ago, and that was when I kind of started 45 years ago, the returns on equity and assets of the industry is about the same as it is today. And so they really have not improved the metrics of the industry, and yet a lot of these other companies, like the Mag 7 that everybody talks, they earn 4 or 5 times on assets and equity that the banks do. And hence the valuation, they grow a lot more, they have new products, they innovate. And that's what the industry needs to get the valuation back that it used to have. And I think hopefully we'll see that in the next couple of years.
And David, speaking of the traditional business for these banks, we've seen a very strong M&A market just for the investment banking arms of these firms over the summer. We've certainly seen the IPO market coming back. How does that factor into your thought around some of these firms, and particularly the major money center banks, the bulge bracket banks that we're more often talking about than some of the smaller players?
Well, the bigger banks have done better because I think people view them as more diversified, less sensitive to rates, less sensitive to the yield curve, although the yield curve has improved of late, less sensitive to sort of minutia regulations. And they also have the money to invest. They have the profits, and presumably they can hire people and pay them appropriately to generate either the AI products or the new products, or do acquisitions, or deal with the regulatory structure. So they have the advantage of size and profitability, and you throw in some decent Wall Street stuff, and it's pretty good. But again, Wall Street is not, Wall Street income to me is episodic, and it's what have you done for me lately? The issue is, generating growth in all of the businesses, and I think that's something that they're trying to do, and I think some people are doing it better than others, but there's still a lot of margin and profit improvement that needs to happen here to, get the stocks to go up even more from here.
All right, we'll leave it there. David Ellison with Hennessy Funds. Thanks so much for the time.
Yep.
And Meta, NVIDIA down 0.8% today. Joining me now is Thomas Hayes, Great Hill Capital Chairman and Managing Member. Tom, a record day on Wall Street. We're seeing that the S&P 500 closed above 6,500 for the first time. A lot of talk about NVIDIA, which has been really the news of the day.
Yeah.
Your biggest takeaways from where this market's at, and NVIDIA, we're seeing a record without NVIDIA actually in the green.
Exactly. I think get ready for that theme to continue. I think the laggards are going to continue to outperform, as we've seen kind of in the last 4 weeks. A lot of the most shorted stocks have outperformed. Small caps and mid caps are starting to take the mantle. The unmagnificent 493 are starting to get bid now. Why? because the unmagnificent 493 earnings growth is starting to re-accelerate from flatline to negative levels just about a year ago, whereas the Mag 7 earnings power is actually decelerating from 33%. This coming quarter will be the first quarter it could be below 10%. So you've had multiple contraction on the 493. That's going to start to expand as earnings grow. You've had multiple expansion on the Magnificent 7. That's going to start to contract a little bit as earnings decelerate. And you saw with NVIDIA, the big story there was data center deceleration. GPUs, for the first time, compute, the core part of data centers, decelerated sequentially 34.1 billion to 33.8 billion. That was masked by networking, but the street's a little cautious on that. And it was a little bit offset by maybe Trump allows them to do a modified Blackwell into China. So the stock held up after the disappointment from earnings. But we have to keep a close eye on that, because that China is a huge figure, and the revenue deceleration from 300% growth rate down to 50% growth rate in a year or so is pretty abrupt.
And it's not much of a dip that we saw today. I mean, 0.8%, but investors do tend to, retail investors at least, buy the dip when NVIDIA goes down. So it'll be interesting what happens there. But I also, we were also talking earlier about Intel as well, and sort of the Intel component to this as well. What's your theory there?
Well, the issue for NVIDIA, the negative sequential growth, is not for lack of demand. They're putting out a great product. They've got unlimited backlog demand. They have a supply bottleneck. They're dependent on the kindness of strangers. If Taiwan Semiconductor ceases to exist or can't give them the allocation, which is the case right now, they're in a lot of trouble. So what they need, the best thing that could ever happen to NVIDIA, is that the Intel deal succeeds and the Arizona 18A node gets online next year to start to produce more capacity of advanced chips for NVIDIA. There's unlimited demand, so what is good for Intel will be good for NVIDIA. Obviously, Taiwan Semiconductor is investing in the US as well to increase capacity. But the reason for that deceleration is their growth. Their revenue growth every quarter is capped at about $4 billion. You're seeing that every quarter. That's not from NVIDIA's orders. That's from Taiwan Semiconductor saying this is all the growth that we can give you, and that's why you've seen that growth rate decline.
What I've been surprised is the leadership that we've seen in this market. I mean, we have seen year to date, we're looking at industrials that's in the green. Industrials is actually the leader. Communication services, tech, utilities, all those touch points that really have to do with AI, with tech, with manufacturing as well. Yeah,
you've got the reshoring theme coming back. I think now that rates are coming down, you're going to see a whole level of new leadership start to come up. Housing's been left for dead. All the building suppliers, all the ancillary players. Autos have been left for dead. The average car on the road is 13.5 years. Now Trump is getting, we've got the steel, we've got the low-cost energy, we've got production going in the U.S. U.S. sell-through has been at depressed levels for the last few years. It's starting to re-accelerate. People need cars. You lower rates, they're going to get cars. Incentives are going up. So I think a lot of laggards now will become leaders, and we're going to see some real opportunity into year-end in small caps and mid caps where you can get double the earnings growth for a much lower multiple.
So is it the rate cuts that is going to propel this market forward?
Yes, I think it's going to propel the rising of stocks under the surface. I think you could see a period of subdued performance for the Mag 7 and outsized performance for the unmagnificent 493. Doesn't mean they'll do bad, the Magnificent 7, just means they'll do less well. And the ones that have been laggards, like you saw this year, last year, industrials, not so good. This year, they're the top leader. The last shall be first. I think we're going to see that in all the interest rate sensitive sectors, the cyclicals, the small caps, the mid caps that people have been afraid to bid. But now that the economy's kind of accelerating, we saw in some of the GDP numbers, they will be good buys.
Some catch up that we'll be watching. Tom Hayes, thanks so much for joining us for this past hour.
Thank you.
And